And as we close out 2022, we're ending a cycle of very subdued M&A activity, down 37% from last year. Joining us now with his outlook for next year is Vito Sperduto. He's co-head of global M&A at RBC Capital Markets. Any reason to think next year will be better than the last, Vito?
Well, Joe, thank you for having me this morning. I would say if I look at 23, I expect the first half to be kind of subdued like the second half of this year. But I also look at 23 as being the baseline for it is what we've done this year, which is still a $1.6 trillion year in the U.S., $3.6 trillion globally, maybe a little bit below those numbers. And if you compare it to 21, yes, it's down 37% globally, 43% in the U.S., but the reality is it's only off about 8 or 10% versus the pre-pandemic levels. And I think there's such pent-up demand, Joe, that when we start getting into the back half of the year especially, and the second quarter is going to be a key inflection here, question is, when do people start getting comfortable with the new normal? Do they feel comfortable financing deals? We're certainly seeing some deals get done right now that are some glimmers of hope in terms of what might happen going forward.
What is Goldilocks for M&A? I figure, low interest rates are great for M&A, but then valuations are high, and then so then interest rates go up, and you got everything's bargain prices because they've all sold off 40 and 50. But it just brings in different buyers? Maybe you get corporate buyers versus PE buyers, or is that how it works?
Yeah, look, I think, Joe, when we look at what's quote unquote Goldilocks, I think ultimately it comes down to when is that CEO, when is that buyer, when is that board of directors confident enough to pull the trigger on a transaction? Right now, the last 2 quarters, we've seen CEO confidence, as the conference board measures it, at the lowest levels since the 08-09 credit crisis. And when you look at that level of confidence, the peak confidence level was in the second quarter of last year, which, by the way, happens to be the largest volume of M&A that we've ever seen in history. So as that comes back, as CEOs, as boards get more comfortable with the current environment, I think then at that point you start seeing people finding ways to do deals. Right now, the parties that are doing transactions are those that are well capitalized, well financed, have access to cash. So if you look in the private equity space, you're certainly seeing deals being done by firms focused on enterprise software. You look at Thoma Bravo buying Coupa about a week and a half ago. They have just raised one of the largest, the largest tech-focused fund in history. They also have access to the direct lenders who are basically focused mainly on sectors like software, where they like annual recurring revenues. You've got cash-rich companies in tech and healthcare doing deals. So when you look at the Amgen transaction last week, certainly they're sitting on a fair amount of cash, but they also have access to investment-grade financing. So as we go forward, those are going to be the parties that are leading the way. And then as soon as we start getting a baseline that people are comfortable with, I mean, Joe, if you back up to when the pandemic first started, everything shut down in the second quarter of 20. But then everybody got comfortable with that environment. They started figuring out how to run their businesses in that environment. And once they had that confidence, then you started seeing deal flow really pick up. So we think the first quarter is going to be challenged, but really the second quarter of next year is that inflection point. The people get comfortable that I have a line of sight as to what this quote unquote potential recession or time frame of recession could look like. I understand the new rates in terms of borrowing. Maybe it's a matter of getting comfortable with where valuations are, whether you're a buyer or a seller, because certainly bridging that gap is a big issue. And in today's environment, I think parties are looking around and say, if you're a public company, you see where public stocks have traded, and you're certainly having to readjust your thoughts on value. If you're private, I think that takes a little longer because you don't have a day-to-day marker that tells you what you're worth, what your peers are worth.